Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Good day, how you going? Welcome to Property Investing Insights with the crew over at the Right Property Group, Reshmi and Victor Kumar in the studio. How you going, gang? Good to see you.
Good.
Yeah. What's happening? Or anything to report?
9 weeks to Christmas.
Is it really 9 weeks to Christmas?
Yeah, so it's getting there. I've actually decided that I will buy some Christmas presents that was overdue from last year.
Okay.
So
He's good at receiving but bad at giving.
Are you a good gift receiver?
I'm an Indian giver.
Oh no, he's bad.
Anyway,
The giving.
this is
part
your
is
show.
mine.
You can. Yeah. I don't
I can be
subscribe into any of
politically
that sort
correct,
of
yes.
stuff. I'm staying well away from that. That
Well,
sort
I
of-
do have a good news to share. Won't you?
Oh,
Yeah,
well,
absolutely. Why not?
Absolutely.
Yeah.
Our home,
Trailblazers.
Oh my gosh, our home got approved.
Oh, did it?
Yes, after like how many years?
Yeah, so the concept started in 2017
Yeah.
and we
Okay.
went backwards and forwards and fired so many consultants along the way to
Okay.
get what we want, understanding that our homestead is a heritage list oldest house in MacArthur.
Yeah.
And I think we've reset the approach with council in terms of what they will approve for a heritage listed home.
Okay, so you're saying faithful to the heritage aspects of the building?
Yes, and
Yeah.
contrasted
Absolutely.
it, and then
Yeah.
contrasted. So retain the main homestead
Mm.
and then contrast it significantly with.
Well, that's
with-
cool.
Yeah,
It sounds like it's going to be something to waste your money on.
absolutely.
Yeah.
Overcapitalized like anything.
Yeah, yeah. So you're not going to care. You're just going to go and
I'm
create
going to go
what you
all
want.
out. Yeah.
Yeah?
If I can put gold-plated tiles on it, I will.
Wow. Okay. Well, congrats. I know you've been sort of fighting the
yeah.
good fight for a while. So
Yeah.
yeah. So this will be a project then for a couple of years, I would imagine. to get it
No,
going
I want
and
to. I want to pump it out in record time.
Okay.
Yes, I've got most things lined up, but we've got 2 birthdays to celebrate before we
Move
start.
out.
So
Yeah.
Reshmi's mum and my younger daughter,
Okay.
February and April. So we want to hit the ground running in May.
So you'll move. You got to move out and find
move
somewhere
out,
else to
yeah.
live and
Yep.
all that sort of good stuff. And probably a year. You reckon?
Probably a year.
Probably a year.
Yeah.
Have you got builders sorted out? And
You're looking at him.
okay.
Yeah,
You own a builder?
I'm going to do an owner build. Yes.
Oh, right. So you're going to be project manager? You're going to project manager?
Oh, of course. Yeah. You know I can't paint.
Sounds like an absolute nightmare. It sounds like some sort of grand designs type sort of.
It
It
will
is
be,
beautiful.
Yeah.
Maybe that's another podcast, updates.
Oh
Yeah.
gosh, it is beautiful.
The Kumar mention update.
Yeah.
It's different to what I shared on my Instagram, and layouts similar,
Yeah.
and it has gone even more better and out there type things.
It's gone
so,
even
Grand,
more. So
Right down to bowling alleys.
have you got a bowling alley?
yeah.
Yeah, you need a bowling alley. Like,
of
as
course
if
we
you
do.
wouldn't have a
Yeah,
bowling
yeah.
alley.
So got the basement, which has got all my stuff, the theatre plus the music recording studio and everything that I wanted, and like every aspect of my living is in that house, laid out in the way I walk around the house,
Yeah, okay.
how I live, and I'm really hoping.
Do you get
that-
the feeling that I didn't get a say?
Well, I don't think you should. What, do you get like a little room or something?
I got my cover
He's
room.
got a corner. He's got a corner.
That's all you need. You've got a corner. You've got a cupboard
Oh,
somewhere,
yeah, that's
right?
it.
Somewhere.
That's it.
Yeah.
Yeah.
Oh, wow.
no, I've designed it in such a way. I must say at this point, for the women when thinking about your own home, it is absolutely important. Like there was a time when we were planning and people were doing the designs and giving us this house and showing how it could look. And at the time, I wasn't even thinking. 2 years went by when I was not 100% with the design. And then one day I was thinking, wake up. This is your home. This is your dream home. This is something you wanted when you were little, how you thought your house would be. So scrap all this that everybody is giving it to you. Just put down on paper what you wanted and then tell them to make it like that. And that's when so the 2 years was wasted by other people providing the designs. And then I woke up and I thought, no, this is my home and this is how I want it to be. And I think it was very different from what Victor had envisaged.
It was a learning experience for both of us in the sense that, and this is true to property investing as well, right? A lot of consultants they're putting their spin on it and their bias on it. But you really need to bring your bias to the table so that it can actually help unfold your vision,
Yeah.
as opposed to, abdicating that responsibility to someone else.
Well, you got to know what you want.
Yes, that's
Yes.
right.
That's like
Yeah.
if you, whether it's building your dream home or crafting a strategy for property investment, you actually got to know what the outcome needs to be, and the relevant people can help you get there, but you need to instruct them and lead them and
That's it.
and
Yeah.
create. So I won't ask you too much about the financial mechanics of it all, but so you've shifted architects quite a few times through this process.
This is the third or fourth architect. Fourth
Yeah.
architect.
How's the architect charging you? Is it sort of a
Too much?
like a flat fee, or is it a component of the build
we
cost?
always
or?
went down hourly rate
Yeah, okay.
scenario, and then there was a capped total figure.
Okay.
Always in play.
Yeah,
So we had the best of both worlds.
yeah, because a lot of architects can charge very different to that.
So one of the architects actually didn't want to take the project on because they thought they couldn't handle it.
Okay.
Yeah. So,
So then this is a process, right? So you've got to create a vision.
Yeah.
An architect will put plans and stuff together, but there's so many connected overlays with that, right? Like you've got this heritage orientated stuff, you've got all the zoning stuff. Like so was the council hard to work with?
They rejected it twice.
Yeah.
Yeah, once at formal submission and once when we're just in consultation with them. So we then, it's how you approach the problem.
Yeah.
And this is true with every aspect of life, every aspect of property, every aspect of wealth creation, is how you change the question you're asking to get to the solution.
Yeah.
And also always asking, yes, this is the hurdle I've been presented. How can we surmount this hurdle?
Yeah, and you've got to have a positive attitude towards that because
Yes.
it's not easy. If you're not willing to take on challenges and conflict and all that sort of stuff, give up now because so it didn't have to go so far to like land environment courts or anything like that. Or,
That was our next move.
Yep. Okay.
If we had been rejected this time around, we would have gone straight to
So
court.
what was it being rejected on what basis?
So, well, it is heritage listed. It is surrounded by 300 vacant acres, so it's got scenic protection. And we needed to show that we are preserving the heritage significance
Yeah.
and yet still modernizing the property, right? So what we did was just simply retain the main house and then building another house with an atrium connecting the two.
Okay. Nice. Well, I look forward to seeing it. No doubt you can give us updates on
Yes.
the trials and tribulations.
We'll see
when
how
your
it
builder
goes.
goes bust,
Yeah,
and all this sort of really good stuff, which is no doubt going to happen. And
We've gone through that in our portfolio with buildings. We've done a lot of construction, so we've had builders that have gone bust on us. And it's how you approach it.
yeah, well, this is you sort of maybe towards the back end of a diversification play with your property investing journey from. You're still in the same region where you started buying investment properties in the Macarthur area, and we were chatting just offline before we come on. Houses in Campbelltown where we've bought. You've bought quite a lot. That sort of Macarthur area. 15, 20 years ago, you're getting in there for a couple of $100,000 now.
Yes.
You can't really get in for
900.
a house for 900, right? Goes to show what can happen in 2 decades, which is a long time to be fair. But you're at that sort of nice part of diversification where you're sort of building dream homes and stuff, but you've been able to probably do that through the mechanics of smart discipline buying as property investors over many years. So, I really want to get stuck into diversification today because it's important. And diversification, you hear it sort of getting bandied around quite a lot. And often it's a bit misconstrued or, you see certain variations of diversification, i.e. houses versus units, but there's a lot more to it. Maybe an overused term, maybe an underused term, diversification. Victor, what's your version? What's your sort of definition of it when it comes to property investing?
I think people get tunnel vision when you talk about diversification because they only think property.
Yep.
Right, but it's all aspects of the property journey that needs to be diversified. And it's just not, only buy houses or have a mixture of units and houses or have different states. There's so many other moving parts we need to address before we even come to the house bit. Yeah. So this is understanding the whole process, the whole journey, right down from lending all the way through to what's happening in the end in terms of paying these properties off. What approaches are you taking? So diversification of strategy, diversification of asset, diversification of the asset nuances, so your leases and all that sort of stuff. So that's what we'd want to address.
Okay, we get into it. And for you, Reshmi, has this sort of idea or notion, concept of diversification, has it been like a present partner for you guys in your property investment journey, or do you think it's happened a bit sort of in the background?
No, I think it's been there. We've always been open to, we realized, because right in the beginning when we were just buying properties without really knowing exactly what we're doing, it comes with the learning, and then you realize you need to step out of one way of doing things. You need to look at lots of other options. So very soon you'll realize you've got to diversify. And yes, you're right. It's diversification is the word on the street, I call it. Like at the moment, everybody's talking about diversification, but it's a word people have picked up. And where is this coming from? So as Victor said, there's a diversification in all aspects of your investing. And so with us, investing in the beginning, it was more like trial and error, but then we realized, hang on, all areas of our investing journey has to be diversified, all aspects of the investing, the property, the area, the finances, the insurances, everything.
Yeah, and
entities too.
Entities, yeah. So there's a lot of mechanical stuff we can go through when it comes to diversification. So the asset class itself, property versus other assets, but then if we're talking specifically around property, where the properties are, what the properties are, houses, units, locations, how you're going to use them. There's diversification of loans, there's diversification of ownership structures, diversity of lenders, diversity in leases, etc. But I guess at the top end, it's sort of diversification of strategy, and no doubt your strategy will dependent on where you are on your property journey.
On the journey itself, yeah. So if I can bring in an analogy, right? So we've got personal trainers that actually help us keep to our peak fitness.
You're looking good.
Thank you. Still struggling with the pot belly though. Too much sugar over Diwali.
Oh my gosh.
So if
Diwali
you
a big thing for
it
you
is a
guys.
big thing. It is a big thing.
Yeah.
Yes. Yeah.
It's sort of something where. Was that last week? Was
week before
last week.
Yeah, and I've
20th.
never 20th.
Yep.
Yeah, so it's like, I know my kids did stuff, and I've always had a bit of a disconnection. I want to be more connected with Diwali moving forward.
It is the festival of light, and it is actually it highlights wealth not just from money point of view, wealth from mentality point of view, wealth from health, fitness point of view, all that sort of stuff. So if I come back to our personal trainer, and this is diversification, right? So if all she did was train our upper body, I'd have awesome packs, right? But I would have spindly legs.
Oh, you'd look like what, Gru?
Yeah, I look like Gru.
Yeah. I know,
So diversification is addressing all the muscle groups and all that, so that you actually you're developing as a whole rather than developing only certain aspects of it. So if you're just diversifying just the types of properties as an example, it's only one aspect. Right, so you could be top heavy on that or really good on that, but the foundations might not be as good. So we need to be looking at it from, okay, what are we diversifying? Why are we diversifying that? And how can we diversify? Right, just because you're buying in a different area doesn't necessarily mean it's diversification. So we need to be understanding the cycles. We need to be understanding the nuances of that area. We need to be understanding what the tenants like in that area, and always taking an approach that our bigger buying pool is always going to be owner occupiers. So do we then chase what everyone else is chasing, where every investor's investing pretty much in the same area because of not so robust advice, and therefore they are creating the markets themselves and getting what I call fool's gold in the sense that you've got anecdotal evidence straight away of growth, but then the fundamental growth isn't quite there, or the fundamental growth isn't as robust as one would think. So this is understanding how different areas work and looking at it and saying, okay, how can I diversify my risk of being in the herd, the lemming syndrome, where we're just simply following each other and hoping for the same result, but we've got different sets of financials.
I think what it points out also is that now this is another dynamic to look at when deciding. It's like, is this growth? It's another factor to look at. The conversation we were having just before about the driving force on the market at the moment. So that would be another factor to look at before you think where you're going to be buying here.
So is diversification, it's not really a strategy diversification, but it's a concept that must be universal
Yes.
in everything that you do.
Yeah, absolutely.
To keep the whole thing aligned, if it's all the aspects have to be diversified, but in line with what you're trying to achieve. And if one is not aligned, like a wheel alignment, it falls apart. So
the key thing then with diversification is optionality. If you get diversification right, you have choice largely.
If you look at what the major components are, right? So obviously the asset is a big component of this investing journey. Then you've got the lending, which is another large component. Then you've got the leases, which is the money coming in. That's another large component. And then you need to then further look at, okay, are we diversifying it in terms of quarantining the risks, in other words, entities? And further on from that, are we really looking at what the tax outcome's going to be eventually? And the maintenance aspect of it. So are all of your homes rather tired, or are all of your homes brand spanking new, and therefore there's no value add to that? So all of those things do come into play.
So is diversification more of a risk mechanism?
It is.
Because I'm just trying to think, there's got to be drivers for diversification. So are you doing it as a protection mechanism, or are you doing it as a growth mechanism, or are you doing it as a mindset mechanism? It's hard to pigeonhole. I guess it's got to depend at any given day.
Correct. And it depends on a journey, where you are in your journey as well. So I think the diversification focus changes as your journey fleshes out.
Yeah. And that's okay for it to change all the time. And it's just a concurrent aspect of property investing that's always operating in the background, but it might become to the fore more often, Rashmi.
Yeah, right in the beginning, I think diversification is what you're looking at is more from the risk side of things. And then there comes a time when you look at being able to borrow more money because you're trying to grow your portfolio, and so you then look at diversifying your lenders and all the rest of it at that point in time. So that purpose of diversification at that time is to be able to borrow money. The first off goes in terms of let's diversify so we can continue to grow our portfolio. Because if you don't diversify, you will be pigeonholed in one sort of, you can't move much more than that. And most people know that buy and hold is the one thing that, they're comfortable with. And because when people talk about investing, it's like, oh, I don't want to renovate, I don't want to do all the, so whether you're an active or passive investor, so people want to just less effort, right? And so diversification would come into play when someone is an active investor and wants to do more, and then they would look at, in order to grow their portfolio, they would then have to look at diversification so that allows them to, be able to access more money or protect their risks. Risk protection, that protect the assets that they're building. So that's where diversification is really important. It's like another thing, a layer of protection that you can carry and a tool that you can use in order to be able to access more funds, to be able to grow your portfolio, and also to protect the assets. So
that's a good sort of theoretical discussion around what diversification is, but to get to the mechanical aspects of it, of which there are many of them, let's get stuck into it. So I guess the first thing would be at an asset level. So people talk a lot, you speak to a financial planner or these other sort of finance gurus you see on the television, they'll always talk about diversification. And by that, they'll typically talk about asset classes. So, they might have some property, you might have some shares, you might have some term deposits, etc. I know property people largely are property people. I know some people who are all property. Their diversification is what entity they hold in, whether it's in a self-managed super fund or outside of it, is their diversification. But how important is this idea of you need to have a diversified asset pool? Does it really matter that much?
It does.
Diversification for diversification's sake doesn't always make sense.
No, it doesn't. And I want to debunk the myth that you shouldn't buy all of your properties in the one area. You can.
Yeah.
You can, right? So long as you're not the market there.
Yeah.
In the sense that if there's 10,000 homes in that suburb and you own 2 of them, you're insignificant, really, right?
Yeah.
In terms of how it'll impact you. So long as you're taking a medium to long-term approach and understand the cycles in the area. But, latching back onto your comment about property guys only talking about property, we've always been an advocate and proponent of always diversify the asset types. So not only in property, have cash set aside, have liquid assets such as shares in your portfolio as well, because you can turn that around a lot faster than you would a house. And understanding that when one asset type falls out of favor, the other asset type absolutely skyrockets.
Yeah.
So if you had your feet in both camps, it will always pay you dividends.
So how diversified do you need to be? If you've got some property, you have some shares, you've obviously got your superannuation and whether that's sort of deployed in some sort of, owned vehicle like an SMSF or, it's with a retail industry fund. Do you need to be even wider or further diversify that? Do you need to have crypto? Do you need to have this? Do you need – because people get obsessed with it. Gold at the moment is everyone's lining up to buy gold because it's the lowest it's been for ages. Like, have you a little safe somewhere full of gold, Victor, that you sit there and count most nights like Scrooge McDuck? But you know what I mean? Like diversification just for diversification's sake, because it just means you need to have a greater understanding of these asset classes and you've got therefore more to manage.
Correct.
And be across or
So you want to make it as easy as possible for yourself, but also not be all in one camp. Yeah, definitely. And then the thought process of, okay, do I plow my super into property as well? You really need to get good advice on that first and see whether it actually matches what you're trying to achieve. And just because your buyer's agent or your broker has said, I'll set up an SMSF, doesn't mean that you should get expert advice on that first, right? But if you come back to diversification in terms of, do I get into shares? Do I get into property? Do I get into units or houses? Yes, all of the above, but in moderation, right? You don't get it to be life consuming.
So it's one of the challenges with diversification, no matter whether it's yourself individually or your peer group or if you're using advisors, there's always going to be a bias that you need to be conscious of. You go to some financial planners, they won't touch property. They'll be getting you to, buy some managed funds or ETFs or some sort of mechanism like that. So no matter where you go, there's going to be a bias.
There will be.
And you don't want to overexpose yourself to too many ideas because it can be stifling I see a lot of people. Diversification doesn't mean you need to get into more complex instruments, financial instruments for the purpose of doing it because someone's got this great idea that no one else knows about, right? Like this is typically red flag type stuff. And I don't know if you see it in your client base, to people come in, rest me going, I've got some trees in somewhere or other and I've got I think maybe we're a bit beyond that.
I've heard that, but you think, okay, is it really going to give you, what are you doing it for? Is it going to really give you returns in this life or in which lifetime? Is it really going to do something for you now? I think when you look at diversification of the asset class, as a person, you need to know, okay, this is your 100%. And then how many things can you manage?
Yeah.
And then, okay, am I going to buy shares or crypto or gold doing all of them, then you've diversified the amount of time you're going to use into all the different managing of all that. And so do you really have that type of time available to manage all the different types of assets? So just pick 2 or 3 or whatever you feel comfortable with, and then diversify that way. If you know that it's not like just because everybody's doing this, I better run and do that too.
A lot of people's view of diversification is parking your dough in an asset for capital growth, but I guess there's two aspects of diversification. One is the asset itself growing in value, and the other diversification is its ability to generate income.
Yep.
And if you're an SME business owner and you're also investing in property, well, you're inherently diversified already.
Absolutely.
And a lot of people don't think that where they generate the majority of their income, i.e., if you're a self-employed business owner, you're already heavily diversified as a protection mechanism for creating capital to invest. So these are the different aspects of diversification. So let's just say then, as part of the diversification mindset, you choose a number of different asset classes where you choose to park your money for the view of getting long-term capital growth or cash flow yield or both those things. So let's just narrow down into property then.
Yep.
So what would be the sort of tenets of diversification inside of property, Victor?
Well, it would be the asset type, right? So an understanding that you'd have different strategies for the properties that you buy. So one could be just a simple buy and hold. And maybe within the same area, you're getting something where you can come back and put a granny flat on it, right? So you're turning that asset, diversifying that in from a growth property to a cash flow or better cash flow property. And also looking at it from diversification of ownership so that you are mitigating your land tax thresholds. Of course, the jury's out in terms of Victoria. Whichever entity you buy in, you're pretty much paying land tax. And that could be a temporary thing, that could be a permanent thing, right? So we need to take that into account as well.
I think you assume it's going to be permanent. Yeah.
When government starts getting free money, it's very hard for them to break that cocaine habit, right?
It's not very often I see. It's not very often I see a government impose a new way for them to generate money and go, oh yeah, let's not worry about that anymore.
Yep.
But you still have those. In Queensland, for example, there's still mechanisms for reducing land tax bills by entities and structures, right?
Yes.
But how long that'll stick around, who knows?
Yeah.
So asset type. So.
Asset type and the strategy on the assets.
Commercial versus resi.
Yes.
Probably one thing you have. And then inside a commercial,
different types.
Industrial, office, childcare centres, petrol stations, retail, etc. In resi property, houses, units.
Block of units.
Block of units.
Zoned properties.
And non-zoned properties. Yielding properties versus capital growth properties. Which state you're investing in. Metropolitan versus regional. It just goes on and
That's
on.
right, And the reality of it, right? Since the stats show that most people own up to 3 properties. The reality could be that you're all concentrated in your one state. Or you're top heavy in one state. That is quite okay. So long as you know that you've got your squirreled away liquid asset, be it shares, be it cash, be it equity within the property that's already been released. It's okay. It's okay to have them all in the one area. So long as you understand that it'll rise and fall within that suburbs cycles. And therefore, you perhaps need to diversify a little bit in terms of the type of property. And also looking at it from a viewpoint of, what's brand new selling for in that area? And if I'm getting a more established property, am I getting the land, bigger portion of land? So we're coming back to the per square meter rate.
And I guess another aspect of type of property diversification would be stuff that needs older and younger, stuff that needs renovating, stuff that's established, stuff that is going to require ongoing maintenance versus stuff that's not. So it's where do you start and stop with this stuff?
That's right.
See, I think it all comes down to the person who is buying, the investor. What are they comfortable with? And within their comfort zone is where we diversify what all they are comfortable with doing. Someone may not even want to do any renovation or anything like that. So theirs would be a set and forget, let's say, for example. So you would do one in Sydney. If they don't have, then again, it's their money that they have. If they don't have enough money to buy a second one in Sydney, the growth is there. As a Sydney property would get you, or New South Wales, like growth. But then if they are limited with their money, then that's what is the deciding factor. So what is the best out there for them so that they can still buy and grow their portfolio using that money. And so the diversification is there, yes, but there's a limitation with how much they can do with the money that they have.
Yeah. So sometimes they're forced to diversify as well, right? So you can't continue buying in the one area because you're priced out. We were talking earlier about the Macarthur area in New South Wales and how when we bought your property, I think it was $200-something odd.
That was at Ambervale.
Yeah. And you can't touch it for $900 anymore.
I sold that. Should have kept that.
I know. But this is another thing, right? So you've diversified your portfolio by selling down some of the assets.
Yeah.
You've got into debt reduction. You've got into different asset types and so forth. That is all part of the greater plan. So we shouldn't really, whilst the Puritan way is hold forever, but sometimes you've got to take one step back to take 3 steps forward.
Well, diversification is what you're talking about there is sort of, upping the type of property that you buy. It gets to a point where
the old bracket creep, right?
Yeah, it's bracket creep, right? And you sit there and go, well, I'd rather have less properties at higher value, give me a different outcome and maybe growing at a different speed than lots of properties. There's still this sort of badge of honor for how many properties you own. Well,
lots of properties is lots of maintenance and lots of decisions.
Lots of decisions, lots of headaches, lots of problems, lots of relationships, lots of everything, right? So, diversification could be more condensed sort of focus. So that's the sort of type of properties. I guess another aspect of diversification, RESME, is probably starts at the structure level. So where and how you own your properties, the entities that you own them in. And there's a lot of emphasis being placed on this at the moment. A lot of professionals out there in a property investment space who are being pretty creative with this stuff, getting people buying in complicated structures for their first properties, whether or not that's the right thing to do. That's outside my pay grade. But it does become important in time that you have a good diversified structure.
Yeah, most people don't buy more than 3 properties or even 5 properties. And so is the structure really important? Is buying in different entities really important? The thing is where you can maximize your
the borrowing?
The borrowing in the taxation side of things, because up to a certain point, things like buying tenants in common or joint tenants and things like that, you can use those to maximize to a level. And then really after that, is it really that important to be buying setting up structures? Because the more you have, the more headache you're going to have with the different entities. You've got to manage all that. And so is it really worth your while setting up those entities and doing it? So diversification in terms of, like, give an example of like where someone is buying, like a granny flat scenario, right? We're buying in a certain entity and then we like 2 people buying it jointly. So can you give an example of a client scenario, just like how then we separate, when the granny flat is built, we separate the two.
You mean the secondary dwelling, so the second house. So often the advice they get, and this advice is because no one's actually thinking of the future. Everyone's so focused on the transaction on the table at the time that your default in most cases is joint tenants. So what that means is that if one passes away, automatically transfers to the other person, and if you have a scenario where you can build a second house and then subdivide it, whether it's strata subdivision or Torrens title subdivision, it is better to hold the property as tenants in common as opposed to joint tenants. So, the difference between the two, the split could be the same or it could be uneven split. But the difference between joint tenants and tenants in common is that in tenants in common, the way I remember it is you can will your share, whereas in the joint tenants you can't, because it's joint. It's 2 entities acting as one. Yeah. Whereas in a tenants in common, the 2 entities coming in together, whether it's husband wife, whether it's brother sister, and when you do end up subdividing it, so long as you don't change the split amounts, so whether it's 50-50 or 70-30, you can hold one title each without triggering stamp duty if it's done the correct way and without triggering capital gains tax. So diversification in terms of ownership is really important.
Yeah.
But most people, as soon as you start talking about ownership, they're thinking, okay, entities, right, as in trusts or companies. Maybe we need to take a back step and say, okay, let's look at it from a granular level. Even if both are owning, can we structure the ownership in line with the strategy for that property?
It's an important point around ownership because there's people holding properties in their individual names, which is where most people will hold their properties. You know, it's only when you get a bit more sophisticated you might start considering, you know, trust-based entities. So that ownership, this is when you need a really smart advisor, a good broker as well to actually sort of understand this, because it can really stifle and hamper serviceability if you don't buy in the correct ownership structure. But yeah, the next iteration of that is the structure, and that's whether inside of trust, outside of trust, inside of companies, outside of companies. It starts getting more complicated. But I guess that expands out to inside of super or outside of super. Setting up your own self-managed super fund is typically what happens when people reach a serviceability threshold in their personal names. The next cab off the rank is typically SMSF, which isn't a bad option.
Yeah, it's not a bad option, but you need to take robust advice around it before you embark down that path. A lot of people actually look at it from a, I've got to continue buying property and I'll buy it in any entity. Understand that super you can't really touch until you're right at the tail end.
It's a lot more restrictive what you can do with your properties inside of super as well.
But it does have merit, right? So buying properties in super fund, provided you've got good advice around it, does add quite a bit of value to your super fund. But I would see that as being another family member investing, not you investing, because you can't touch it.
You can't touch it, So someone get the upside.
Yeah. In my head, there's a song playing right now.
Yeah.
Can't touch this.
So you guys haven't prioritised SMSF?
Oh, we've got properties in SMSF.
Yeah.
Absolutely.
Yeah. But it's hopefully you live a long and fruitful retirement. You can leverage that in time, but the retirement age is only going to get
pushed further and further out, right? So if you look at population, it's an aging population. We are not getting as many working migrants in as we would like to. I think the play they're leaning towards is getting more international students and making their visa process fairly easy to then remain here. But our population's aging faster than people that are actually going to pay tax to support the aging population. So natural thing would be we'd have to push out the retirement age.
We're going to need it, right? Because they're going to fill the tax coffers.
I know.
How do you do that? You get that through workers, right?
Yes.
You need more people in the workforce. And that's just the nature of it. So that's the sort of structural ownership aspect of it all. Another layer of diversification recipe would be sort of your finance and the sort of loans that you have. And that can be whether it's principal and interest only is one level of diversification. It's the LVR you're taking your loans at. It's the type of lenders that you're using. Again, this is another whole aspect
variable or fixed,
Yeah.
and the different lenders, the different tiers of lenders. And again, sometimes when you look at how easily you can access the funds, and so sometimes depending on which lenders you would approach based on your own financial circumstances. So there's a whole wide range of lenders out there, and not just sticking to what you know, also using brokers to be able to tell you where you'd be able to make the most for your money. So second tier lenders and the low doc loans, as they used to be called, and all the rest of it. So there's in finance there's a whole lot you can do, and that's where you need a really good broker who can help you sort out.
That can advise you well ahead of when you're going to hit that lending hurdle.
Yeah.
And
forward planning as well, because you know that this is your plan, this is how many properties you want to buy, and this is where you're going. And so someone who really understands that can map out your financial journey in terms of like the loans and all that side of things, and work with you to keep you scalable, let's say.
Yeah. When is being too diversified when it comes to finance Too
When
much.
your loans are too small and you just scattered them all across different lenders,
Yeah.
you need some level of concentration with each lender to get the discounts.
This is important.
It
Right?
is
so the
important,
more debt you
yes.
have,
Yeah.
so there's a point where they really like you as a customer, and you will get preferential pricing up to a point, and then you'll get to a point where you go, no more money for you
Yep.
because you're overexposed on a risk matrix, and
That's true.
it'll be different where
It would be.
depending on
There's
the lender.
something about the lender's mortgage insurance as well when
Yeah.
depending on in which area that lender's mortgage insurance has reached its cap.
And so you need to use a different lender with different
lender
mortgage
with a
insurer.
different mortgage insurer because then it will be cheaper for you to get the loan. So
And often you sit there just going like, it depends how creative you want to be, but it gets to a point where you must see with some of your clients where you just go, shouldn't do anymore. Just stop. Like, just
Absolutely.
stop being.
Yeah.
Don't try and be too tricky.
Yeah.
You know,
Yeah.
go,
Yeah.
I'm going to move to this lender. It's got a different insurer, and this is going to I've got to keep buying.
Yeah.
Like
Yeah.
sometimes it's
So
just unnecessary.
mistaking action for results.
Yeah.
Yeah.
the main thing people should have in their mind is this is what I'm trying to achieve, and then stay within the actions you take has to always be reflecting that is it getting me to where I want to be, or I'm just taking lots of actions for no reason, or I don't need to. But so if you have, and if you don't have a way of describing what you're trying to achieve, then bring it down to dollar terms.
Yeah.
So what is your asset level? What is your cash flow level that you're trying to achieve? And then all the actions that you will do is towards that, rather than just doing so many actions, doing all the different things which you may not necessarily need to do,
Yeah.
and invest comfortably.
And that's the point, right? You know, it's in terms of diversification, you got to be comfortable.
Mm-hmm.
You know, you don't want to be, and there's going to be different points in your journey where you may be redlining more than at other
absolutely.
times, and that's okay. But you can't redline forever.
No.
Because it'll all come unravelled at some point. So if you've got this sort of house of cards, if one bit doesn't move as you need and it all comes tumbling down, that's over-diversified,
Yeah.
right?
Yeah. Your portfolio on spindly legs.
Yeah. Does that happen a lot? the group portfolio.
Look,
Yeah.
it does, right?
Yeah.
And you'd be surprised as to how many people I talk to that want to take on my services, or they've already an existing client. When I tell them, no, you need to stop buying. You don't need to buy anymore. Do X, Y, and Z.
Yeah.
And you just need to let time do its magic.
What's the most ambitious retirement sort of plan you've heard from? Maybe overcooked retirement plan you hear from people around generating passive income through property investment.
Hitting 500K in 2 years' time.
Okay.
Yeah, and you've got 100K to start with.
And do people actually think it's achievable? And
They
why
think
do
that
they think that's?
if you're engaging a property strategist, that we've got this magic bullet that will make it happen.
Yeah.
But you've got to have the ingredients first to be able to be successful. And really, and this is why we're talking about a decade, designing a decade, is that we need it to give a good 10 years so that time does its magic, the portfolio matures, your thinking matures, and you're getting through your different stages of life to actually get to the fruits of your labor.
It's a good point,
Yes.
that. And we're talking about
Absolutely.
diversification and all the aspects of diversification, but the biggest factor that will influence your success as a property investor is time.
The biggest thing that'll influence it is you.
Yeah.
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 Then time.
Then time.
Then time.
Then time.
Yeah.
Yeah.
Because
It's
you can
grow as a
make or
person.
break it. Yeah.
You grow as a person, and your thinking changes, and I think that's the wisdom we bring to creating somebody's portfolio. Because if they're young, they haven't had that experience, so we can see how this portfolio will, go, and how we will create it, what the journey will be, because we're looking at their life, what life stages they're in at the time, so we know how it.
So you guys can look at something, you know how it's going to play out.
Yeah,
Yeah.
well, I'll give you an analogy, right? A year and a half ago, I was teaching my elder one how to drive, right?
Okay.
And I'm okay, thank you.
Yeah. Okay, you made it through. You
Yes.
passed. Yeah.
So we were going down the road, and I said, slow down, right? There's someone crossing, and like dutifully she slowed down, but then there's a guy that came from behind a car and crossed across the road, and I said, oh, how did you see it? And I said, well, this is years of driving where you've got the peripheral vision all tuned in, right? And the same is true with property investing. sure, everyone can drive, everyone can invest, everyone can buy. Buying a property is not hard. Yeah. But it's the person crossing the road that you're going to have a crash with. That's the things that we bring to the table to say, slow down, this is what's going to happen.
Yeah, and this is the wisdom. This is a really good point. It's the wisdom and appreciation of experience and sort of being able to telegraph how things will play out. And you could probably see people going down a pathway. You know it's going to end badly, and hopefully you can avert it. And,
There are many times we've seen, especially some people I wouldn't mention, but we see that they're doing it wrong, but they're not willing to listen.
Yeah.
Yeah. And
Are these people that come and ask for help?
Yeah, they want to, but we just decided not to help anymore.
Yeah, okay.
Yeah, but that's
because there's so many times you can tell them to do it this way.
Yeah.
And years have gone by, but people don't listen. And when they don't listen, you just don't want to be involved in anything like that.
And I think what Reshmi is talking about is
you're not talking about me, are you?
Apart from you, yes.
Yeah.
When you're investing, when you're successful, right, all your friends and family, particularly family, will want to know how you've done it, but they'll want to reinvent the wheel.
Yeah, okay.
Yeah, so they'll do it their way. Yeah. And that's something that...
Or suddenly they'll become an expert
themselves.
But so on that basis, then you need to have, in terms of diversification, you need
advisors,
and your peer group.
Yes.
If you live in an echo chamber, you're only going to get one outcome from that. So diversification of fortunately with property investment, there is a number of different ways you can get varied information. Podcasts like this, for example, there's a lot of property podcasts out there which will give you a different lens of things, but it's who you choose to associate yourself with, whether they're a paid advisor or whether it's your peer group, will really determine your skills and capabilities as a property investor. Another aspect of diversification, and people get absorbed and obsessed with property investment talking about what to buy.
Yep.
That's only one very, very small part of it. So you do that once.
Yeah.
Per any property, and then you may hold that property for 30, 40, 50, 100 years, right? If it's a generational asset sitting inside a trust. So, the concurrency you're going to have through the whole process is the tenants and the property managers, if you choose the property manager.
Yep.
So that's probably one of the most important aspects of diversification is number one, getting the right team, but number two, layering in, if you are building out a large portfolio, variation when you lease renewals, the property manager you use. Like, how varied do you need to be with your PMs? Like, because property management is a really tough job.
It is tough.
It's a tough job, and it's quite
and
transient.
not that many good ones out there.
Yeah, it's very transient. So when you get a good one, you want to try and hold on to them.
Yeah, absolutely. But then also, you don't want to have the property too far away from them either. And I've got a live situation with one of my clients that didn't have a good experience with the property manager within that suburb, and was having an awesome experience with a property manager that was about an hour and a half away, and transferred the property to the hour and a half away.
Good.
And of course, that didn't end up well.
It's still very localised property investment. You would normally use a real estate agent within your local area.
Correct.
You want them to be sort of 5-10 Ks, right?
Yes.
You should be able to find a good PM without.
You should,
unless you're in a real marginal area.
That's true. Yeah. So if you are in a very small regional area, you probably got the choice of the best of the bad bunch.
Yeah.
Yeah. Not saying that they're all bad bunches, but that's your choice is limited, as opposed to if you're in your metropolitan or major hubs. Then you have more diversity of choices in terms of property managers, and don't go for the brand name, go for the person. That follows the system.
Yeah, and it's probably one of the most important aspects of your portfolio, which again is really over considered when it comes to discussion around property. Is your PM needs to be good, right?
Yes.
Because they're essentially your connection with the tenant.
They're your time protectors.
Yeah. And what about this sort of variation on diversification of lease renewals, type of leases? So, what do you guys like, 12-month leases, or do you like sort of rolling leases? Does it really matter that much?
It doesn't
the tenancy
matter.
laws has changed so much. So.
It also depends what you're doing in your portfolio at the time. Because when you are building a granny flat, let's say, then if you've got the tenant in the house next door, then when it comes up for renewal, there's a little bit of a different type of a lease renewal that you would do, because you'd have to the new tenant moving in, the building, the impact that they will have with the construction on next door, and also when it comes to what were we doing with the 13-month. So
depending on the legislation in the state, right, as to how often you can increase your rent.
Which is largely only 12 months now, isn't it?
Yeah, it's geared to the house, not the
its
tenant,
tenant.
right?
Yeah.
So if we started doing 13-month leases instead of 12-month leases, you've got a bit of diversification where you could actually be outside of that 12-month rule and be able to increase your rent independent of the 12 months. Again, check with your property manager first.
And this is also, you don't want all of your leases falling due in December, for
No.
example, from a cash flow point of view.
Yeah.
So you really
Yeah.
want to spread it out as a risk protection over the period of
Yes.
time. But I guess also it's around strategy. If in terms of leases, if you're looking to sell a property or renovate a property or do major renos, so once a 12-month fixed lease, there's no obligation that you need to continue with that person in your property.
No.
You have no ground evictions now, but
Yeah, you do have, but I think most states are moving towards you can't really kick the tenant out unless you're actually doing major
Something.
renovations to the property, selling it or moving into it. Yeah,
so if you're going to
or-
sell,
yeah.
you don't want to be on a rolling.
Correct.
You need to really time all those things
Yes.
up pretty well. So there's lots there, and it's complicated.
It is, but it can be very simple as well.
Well, it should be simple.
In the sense that you're diversifying but not over diversifying. It's okay to have concentration in areas, and it's okay to have just the one asset type. It all comes back to how you operate as a person, as a decision maker, how you operate as a finance manager, and how your goals are set up and what strategies you're implementing.
Yeah.
So get your team right, and the team that you have today might not necessarily be the team that's going
Correct.
to take you into the future.
Yes.
Diversification of the type of advisors you have will grow and expand. I know a lot of people that outgrow their accountants and they outgrow their brokers.
Or the accountants outgrow them.
Yeah, absolutely, which happens as well. And that's all okay. You just need to have a level of consciousness with it. But I think you said, Victor, we're looking down the barrel of Christmas. What did you say? 6 weeks?
Nine weeks.
9 weeks away. So this is our sort of special series on Design Your Decade. We're now 10
Pretty
podcasts
much 10
into it.
podcasts in. Yeah.
So we've done debt, we've done a whole bunch of other stuff, but we've done debt, we've done defense. The last time we spoke about, now we're spoken about diversification. I think, it's a concept that is going to have currency throughout your property investing journey. No matter what you're doing, you're always doing some, whether you're diversifying for the purpose of risk minimization, where you're diversifying for the purpose of, expanding or accelerating growth. There's always going to be some rationale reason for it, but you need to check in on it quite often, I would imagine.
It's a tool you've always got to use in all aspects of, whether it's a property or finance or anything that you do, what's the best way to go about it. And that's where when you find you've got more properties, then obviously then you've got to be buying too many, then you've got to diversify. You can't just buy them one time.
So you guys would be happy to do a diversification debrief with listeners if they're sitting there going, wow, these concepts look great. I haven't really thought about it. Like, that'd be probably a good reason to chat with you guys. Because I know you're doing, last time we spoke, you're doing like portfolio reviews.
yes.
Yeah. So that would be part of it,
That
right?
would be part of it.
Yes.
Yes. Yeah. So often when even if a client's not in our ecosystem, when they want to start up with us, I look at all of their existing portfolio and we do some really good goal setting to then start purchasing properties rather than I want a property here. Okay, I'll go out and get it for you. There are plenty of other buyers agents that can do that for you. We set a strategy in place and we're looking at it from a medium and long-term aspect. Our crowning glory is that we've bought a property for the granddaughter of one of our clients.
You already hit a granddaughter.
Yeah. So that's
pretty cool.
generational investing.
Wow.
Yeah.
That's good. What do you say to people, and whether or not this is a thing, and I think it is because I hear it from a whole bunch of different people. You've been doing this for 20 years, right? If you're doing near on 20 years, 20, so you're investing, but as a buyer's agent, so you're doing, third generation property investment. There must be sort of inherent frustration with people sitting around saying, I've chosen the right property group to partner with, but I really want to get moving. How come you can't find me something like, you get these people sort of sitting there waiting and going, well, what do you say to those people?
Look,
must be hard conversations.
It is, but once you put it in perspective, they understand what we're trying to do, right? And there's no secret, right? RPG is very slow in finding properties, because we go through such a rigorous checklist and we don't overpay for the property. So we don't get caught up in the hype of the area. So we're still looking at it as if this is the last property you'll ever be able to buy. So you need to make it count. Yeah. And so understanding that you may miss the spike in the market, but you haven't missed the growth in the market. Yeah. And often when spikes happen in the market, the spike goes both ways. It goes up and it comes down as well. So we need to understand that and what the catalyst is, why that spike is being caused in the area, and set that aside and look at the fundamentals and say, okay, does this still work? If the fundamental growth is going to be there, will it work for your portfolio? Will it work for the addition to the portfolio you already have? As opposed to, okay, everyone's buying there and, the advisors and the first home buyers and the home buyers, they're paying more and more because they're trying to get in the market because they're seeing social proof of growth. Yeah. And therefore they become the market. Yeah. And that's the hardest thing to recognize.
So debt, defense, diversifications, what next when we get together?
Well, we'll be talking about direction, because that becomes really important as we get into the tail end of the year, when you've got all of these things coming to a point where you realize, hang on, I haven't even achieved my New Year's resolution.
Maybe that could be me, lack of direction.
It could be.
I sometimes lack it in property investment. I sort of speak about it.
So we'll talk about that, and then the final piece obviously will be the actual strategy at a very, very high level. So that it all ties in together. So it's a closed loop. And we started with planning. We've gone through all of the mechanics, the different things that we need to look at over the last 12 months. And then we tied back in with, okay, what's the strategy and how does it relate back to how much money you've got and your age group and your appetite.
Look forward to it. Well, thank you, guys. And congrats on getting the start of your journey, building your new home.
I know.
It's all going to end in tears.
That's right. But it'll be tears of joy.
It'll be tears of joy.
joy.
And be careful what you wish for. Like, it's when you're doing it's very ambitious and bold. It's great. It's great you're doing it, but you got to be a pretty good campaigner to
I was about to, I was waiting for this last result. And if it was not happening, I was going to just forget about it all and move to the city. Yeah. And that's what I was going to do.
Great. Do it anyway.
Do it anyway.
That's right. You selling yours?
Me? No. I'm a buyer at the moment. So we'll have to have a chat about that. But best way to track the team down?
Yeah, just go onto the website, rightpropertygroup.com.au. There's a contact me form there. And click on that. And you'll be in touch with us.
Magic happens. There you go.
I'd like people to say in the podcast comments if they're liking the Design Your Decade episodes of the series.
Well, there's downloadables as well, right?
Yes.
There's you get all that on your website.
Correct.
So go and check that out. So it's Design Your Decade. This is our special series with the team over at Right Property Group. This is Property Investing Insights podcast. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.